St. Louis, and welcome to What Retirement Means to You with Jerry Means. He is the founder of the Means Financial Group right here in St. Louis. I'm your host, Spike Spangle. Jerry, first of all, you're looking great today.
Oh, thanks, Spike.
How you feeling?
I feel great.
Fantastic. The markets, not so much.
No.
So we do have to talk about market volatility today, what it means to you, the retiree out there, and are there other possible solutions that you can avoid while still having growth in your portfolios and not having to worry about this roller coaster ride that we're seeing out there right now. For you, are your clients calling you freaked out right now, or are they comfortable because they've already had a plan in place? What are the conversations you're having with folks here in St. Louis?
I think most of the people are comfortable because we had a plan, but they still want reassurance. You know, so I'm having a lot of phone calls, even if it's just a 15-minute call with my clients saying, hey, don't worry, we've planned for this, right? I mean, we segregated their money into different buckets to do different things. Mm-hmm. And the money that they have in the market is the money that they're going to use in the back end of their retirement, not the money that they need for income right now. So we can go through some of this volatility. We still want to manage it, right? But it's not going to affect their total plan.
Okay. So with the market volatility going on, I'm sure you've had clients that were in some market assets prior to this, because you can't completely be out of the markets. Are you adjusting things? Are you adjusting your ratios of the portfolio management at the office right now with your group? Or is it still, let's see what happens before the end of the year?
Well, we're doing a lot of bond replacements. So, you know, historically, we've had bonds in the portfolio as part of the safe part of the portfolio. And they're just as volatile as the stocks right now. So we're looking at maybe dividend portfolios. So that's a stock that pays a payment to the shareholder, mm-hmm. And they tend to be the big box companies. So the volatility of the pricing of that stock isn't usually going to go drastically in one way or the other. But you're getting that consistent dividend year after year. So we'll look at, okay, what do we need for an income tool? Maybe we use an annuity to give them income and increasing income in the future. Then we want to look at, okay, how much do we want to have in the market and how much risk do we want to take on that money? And we want to look at the best strategies for that concept. Okay,
so interesting, if I'm taking away that correctly, you're leaning a little bit into the markets because you're saying the bond markets are doing so poorly. That's usually where people run to cover for safety when things are volatile like this. But then another thing you said in there was the annuities. Now, there's all different kinds out there. Are annuity solutions for everybody?
So it depends on what you're looking to do and what your situation is. There's no cookie cutter solution for everyone. But it's really important to understand the different types of annuities, because if you Google annuity, you're going to get all kinds of opinions, you know, all kinds of pros and cons.
And there's some names out there that say, don't ever do it at all. And there's some people who say that's the only thing you should do. You get both sides of the spectrum.
Yeah, and I think people are getting wiser and understanding that annuities have evolved and that they may be a safe haven compared to the stock market. So to give you an idea, there's three basic types of annuities. You've got a traditional fixed rate annuity. Often they're called multi-year guarantee annuities, or MYGA in the industry. That's just industry jargon, but they're, you know, maybe 4% for 5 years, right? You're not going to write a letter home about it to mom, you know, about the great interest rate that you got. But when you look at what
you're not going to be bragging at the water cooler at work. Yeah, oh my gosh, I just got this MYGA recently, 4%. This is fantastic.
Yeah, I never thought I would say 4% was a great rate, but
I know.
Over the rates we've seen in the past, you know, that's not a bad rate. You know, and you have to look at all the ins and outs and the disclosures of that contract, make sure that it's right for you and have that discussion. And maybe see some illustrations and things like that, play some what ifs. But that's just a traditional fixed annuity. The thing is, there's no risk. It's going to pay you more than sitting in cash, and it's going to pay you more than what the banks are offering on their CD rates. And they're pretty close to what bond yields are anyway, without the bond risk. So I like the fixed annuity for certain situations. Maybe
so that's one type, saying fixed annuity.
And the other thing about that, before we talk about the other ones, is it's short term. So let's say interest rates do continue to rise, like we suspect they will. In 5 years, you shop around for the best 5-year deal again. right? So if interest rates are paying 5 or 6% for 5 years, it's liquid after 5 years, we can move it over.
Okay.
So that's one solution. The next is kind of on the other end of the spectrum, which is called the variable annuity. And the variable annuity often is the one that's getting the bad press, in my opinion. A variable annuity is in the stock market, so you're basically buying mutual funds like you could on your own, but you're paying fees that are usually higher than regular mutual funds. And then there's administrative fees, there can be rider fees. Often I'll find out that someone thinks they're paying 1.25% fee, they'll come to me, we'll do that review, and I'll call the company because I know the questions to ask. And I love doing it on the speakerphone with the client there so that they can hear everything that's said. And I'll start asking about the fees, and I often get that eyebrow raised, right? Like, oh, I didn't know that. And we'll find out they're paying 3 to 4% a year in fees. Well, if you have $1 million paying 3 to 4%, that's $30,000 to $40,000 a year.
Wow.
That you're paying in fees internally. And if the stock market...
something that essentially you could go out and get on your own on any trading platform in a mutual fund. And if I remember on another occasion, saying they're using mutual funds, there's even lower cost instruments you could use in exchange traded funds.
Absolutely. Now, you do have to know with the variable annuity, it is tax deferred. So if you are trying to defer taxes, that's one of the benefits, and that's on all annuities. And then it has a death benefit. And essentially, on most contracts, the death benefit is the amount that you put in. So you put, $500,000 in, market drops, you're down to, $450,000, and you die, it'll pay the $500,000 that you originally invested. But again, you're not going to see that. That's for your beneficiaries. But if you're needing to draw off that for income, probably not the best solution. And often people don't know about those fees, so that's where, I think they get the bad rap because they haven't been properly explained often, or people didn't understand it when it was explained. There's a vehicle in the middle, a hybrid, called the fixed indexed annuity. The fixed index annuity gives you some of the upside of the market with zero downside risk. So to give you an example, if the market goes up 10%, they might have an 8.5% cap. So when it goes up 10, you're only going to get 8.5. If the market goes up 8, you get 8. So, if depending on what you think the market's going to do in the future, and here's the thing, if the market goes down and you get a 0, what happens usually when the market goes down? The following year or the year after that, we get a big recovery, but you don't have to recoup losses. You've already had your money fixed at that plateau, and so you just reap the reward of the recovery. So it can be a great way to play the stock market. I often call it playing the stock market for scaredy cats,
Yeah, I gotcha. We'll talk more about those. We have to take a quick break, but if you can tell me, what exactly is the on-track retirement review? Is it only for those who haven't retired yet? Can you also use this if you're in retirement?
So the on-track review is for someone that's within 10 years of retirement or already retired. We want to make sure that you're on track to cross that goal line, but we also want to make sure that you stay retired. We want work to be optional, right? Not mandatory. So when you come in, we're going to do an on-track review. We're going to look at the fees that you're paying. If you have an annuity, we can talk about what type of annuity is and if it's the right one for your portfolio. We can look at different fixed income options. If you're looking to maybe replace the bonds in your portfolio, I can show you some alternatives to that. And then we're going to look at, is there any tax planning that we can do? So we really cover the holistic part of the retirement plan. And we're offering that at no cost and no obligation to the next 10 callers.
Jerry, we're going to take a very short break right now, folks. Please take advantage of the complimentary offer to get your on-track retirement review. If you're a few years away or even if you're in retirement, is your money going to last all the way through your retirement years? With the inflation and the stock market volatility that's going on right now, you need to be certain. Call 844-878-1293. More with Jerry Means and what retirement means to you, St. Louis, right after this break.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have by running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go, and who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no-obligation, full-blown financial review today.
Welcome back to What Retirement Means to You with Jerry Means. I'm your host, Spike Spangle. Today we're talking about how the market volatility today is scaring a lot of folks who are getting ready to retire and who especially are in retirement. I mean, the nest egg they have, they're watching it go up and, more importantly today, down. And you do have solutions for folks. I mean, right now, just over the last few weeks, we're looking at the market being on holding from the year about 20% down. Who knows what's going to happen by the end of the year? Maybe there will be a great rally. But do you have clients or folks who you've talked to or worked with that you could maybe share with the viewers out there of how you've already provided solutions for them over the history of working with them?
Absolutely. So I have one client that comes to mind, and I've been working with this household for almost since the beginning of my career, almost 20 years I've been working with them. And I met them at a speaking engagement. They came into the office and, we just hit it off. And throughout their retirement, we did a lot of this safer alternative investments because they were very, cautious about their money. They've been through the dot-com bubble bursting. They had been through the '08 financial crisis, so they really had seen all that and they just didn't want risky investments. But we also built in a layer of income planning. And unfortunately, the husband passed away last year. Oh. And so the wife came in, we sat down, and she said, Jim always told me to come and talk to you if anything happened and that you had everything set up. And so we did. We went through, and I explained everything again, because Jim kind of took, the reins with everything. Sure. His wife was always in there, but Jim kind of handled things. And so I had kind of re-explain and, go over what we had done, and that we were going to be able to replace her income that she was going to lose from the Social Security drop-off and the pension drop-off, and that she wasn't going to miss a beat. And she said, Jerry, she goes, we prayed that someone would come and help us, and it looks like, our prayers were answered, which was very flattering for me. Yeah. But yeah, I mean, it was really nice to see that impact. I like helping people cross the retirement line. That's always fun, seeing your clients actually get to retire when you've been working with them year after year, and now they get to cross the finish line and get into that retirement. But it's also gratifying to see how we can help people even in those type of situations where, it's a sad situation, but it had an outcome that, that what she wanted. So
right, and it's wonderful, and I appreciate there's so many couples out there, and whether it's the female who leads in doing the finances or the male, but in that time of tragedy that someone doesn't have to make a decision or have to start digging into all of this, they can just seamlessly know they can call this financial person who they've already built a relationship with. It sounds like you've known them for a very long time. Other clients like that as well. I'm sure, like you've said, you've got to see them cross the finish line. I'm also sure that's probably not the first time you've had a phone call that client has passed away. What do I do now? And it sounds like you get to say to them, you don't have to do anything right away. Focus on your family, focus on yourself first, because this stuff has already been taken care of.
Yeah, I mean, the worst thing that you can do is have a knee-jerk reaction, right? You want to sit down, weigh everything out, but you want to do that after some of the emotions have wore down a little bit.
Right.
We have client households that we're already on the third generation, believe it or not.
Really?
I've been doing it 23 years, so some of the clients that I took on board when I first started have passed away, left money to their kids, left the estate to their kids, and unfortunately some of them have passed away and left it on to their kids. So I actually have a few households that were on the third generation, and we've just kind of seamlessly helped them make that transition each time that happens. And again, that's really rewarding for me to be able to help them.
Right. So let me ask you a little bit about it, because I know that you work on the investment management. You look at other solutions such as life insurance or possibly annuities if it's appropriate. You've talked a little bit about healthcare, even looking at long-term care needs. And now it sounds like you also help with legacy planning and estate planning. Jerry, there are way too many hats for you to wear. I know you can't be a lawyer as well, right? How do you help out with this?
So I do tax planning, but I don't do tax preparation, right? You go to an accountant, they're doing 900 tax returns during tax season. So a lot of people say, well, why didn't my tax accountant talk to me about this? Because they're doing 900 tax returns over a 3-month period. They're just so busy. And a lot of times those accountants are working 12, 15-hour days, that's when they get it done. And then they're exhausted, right? They don't want to talk about it anymore. So it really comes down to, don't just get tax preparation, do some tax planning. So we're helping people do that. We're looking at their Social Security, when's the best time for them to draw. We're looking at all their different pension options. And one of the things that we're seeing is kind of the great resignation, right? Through the pandemic, a lot of people have switched jobs, companies have downsized. So there's these 401ks left in these old employers, in those old accounts, and people don't know what to do. Well, that's where we can sit down and really walk them through that.
So speaking of, again, with this market volatility, if you've left an organization or if they left you, would you say now is the time to call and get those accounts so you, whether it's you, the viewer, or yourself, helping them manage that? Because who knows what could be going on with that organization that is downsizing? Who knows what's going on with the plan? They can change plan administrators. So it may have been that you left on your own terms or you didn't. Either way, do you want to call those numbers? Can you help at all with that when folks are leaving organizations?
Absolutely. I mean, it's one of the things that my practice is focused on, right? Making that transition. So, I mean, there's not too many companies in the area where my office is that we haven't helped people retire from. We've got companies like Ameren, Monsanto. We had all the car dealerships for a while. We had Chrysler there, so I used to help people with their Chrysler retirements. So Boeing. We have a big Boeing factory there. So, so we've helped people with a lot of those different companies. So I know the ins and outs of those plans. So it's easy for me to sit down and explain to someone what their benefits are.
So you're not just some national financial personality. You're based right here in St. Louis. You know the needs of the folks here in St. Louis. We know the sports, we know the weather, we know the food here of St. Louis. But more importantly, you know how to help people be and stay retired. Tell me a little bit real quick before we go out to break about the stress test, because with the market volatility, this is what a lot of folks are calling in on. What does the stress test help them with?
Well, in the old days, I like to say, brokers would tell people to, put their money in the market. Over time, it's averaged 8%. If you pull 4% out, you're not going to run out of money in retirement. Well, I think we've learned that that's not exactly true. That's great in a bull market that lasts for 20 years. But you have to be careful about sequence of return risk. So what we do with the stress test is we use a software program, and we're going to plug in all the data points, all the different income sleeves that they have. We're going to look at what their holdings are and say, okay, what if we have a good sequence of returns? How is your portfolio going to grow, and what are you going to leave as a legacy? What if we have a bad sequence of returns? Are you going to run out of money in retirement? How is that going to look? And then we can look at just the average. And we can tweak and test that till we get to where we're satisfied with the numbers. So it's a tool that we can use to help visualize and show clients how we can help them with that.
And that is something that you're offering complimentary right now. Jerry, we've got to take a very short break. I'm going to be right back. Folks, get your own stress test on your investments. All you have to do is call the phone number right here, 844-878-1293. You can get your own complimentary investment stress test to find out if your investments are going to last all the way through your retirement, and more importantly, provide you the income you need while you're alive right now. More what retirement means to you with Jerry Means when we get back after this break. Please call the phone number, 844-878-1293. Retirement solutions for you right after this.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Welcome back to What Retirement Means to You with Jerry Means. He is the founder of the Means Financial Group right here in St. Louis. I'm your host, Spike Spangle. Jerry, I'm sorry, you glanced over something right before the break, and I've got to ask you a little bit of a definition. I've heard this before, sequence of returns. It's actually called a sequence of returns risk. Can you explain for us exactly what that is?
Absolutely. So we can cherry pick. When I'm meeting with clients, I like to tell the story of two brothers, right? So Bill retires in 1990, right? From 1990 to 2000, that decade, we had a great sequence of returns. We had the dot-com inflated market, right? We know the bubble burst in 2000, but from 1990 to 2000, it was a great market. So Bill has, let's say 500,000 in retirement. He's pulling 3%, per year for income. By the end of that decade, he had more money than he started with. Pretty good retirement plan. It worked. Well, his brother, John, retires in 2000, exact same strategy, but by 2010, he's out of money. He's broke. And he had the exact same strategy because he got a really poor sequence of return. We had the dot-com bubble burst in 2000. We had for 3 years, the market went down.
Yeah.
Then we had the recoveries in the 08 financial crisis.
Yeah.
I call it the lost decade. Because if you look at the stock market, when I say the stock market, I'm talking about the S&P 500, the broad market. If you look at it in 2000 and look at it in 2010, it basically is like the valley of death. I mean, it just goes down and comes right back up to where it was. There was no growth over that 10-year period. But he was pulling money out as the markets were down. So again, two different people retiring in 2 different decades with the exact same plan, different outcome. So that's what we mean by
sequence of returns. So it really depends. Now, how do you control that factor, though? Because if you take a look at the markets being down right now and inflation being really high, somebody might be saying to themselves, well, this then isn't the year for me to retire.
Well, I think it's really important to be diversified and to take your portfolio and put it in different buckets. I always talk about the bucket strategy. You want to have that safety bucket. That's your cash bucket that if you have an emergency, you can go down the street and pull that money out right away. You're not going to earn anything on that money, but it's liquid and it's there. Then you have your income bucket. This bucket is designed just to meet your income goals, to solve that gap between what Social Security and pensions don't cover, and we want to filter in inflation for that, right, to increase that. So we don't want that money in the market. We want to draw a line between those two buckets and your risk bucket, right?
Okay.
That the risk bucket is okay to put in the market, because let's face it, the stock market's just the largest casino in the world, right? I mean, you can manage it the best you can, but there's so many things that are out of our control, right?
Well, there's so many things that are out of our control, and there's also things that are out of our control, like our own emotions, the behavioral finance aspect of it, and that we react to things. And that's, I think, in part what a financial advisor can help you with, is not reacting to what's going on. There's a lot of fear, there's a lot of worry, there's a lot of concern. There's a lot of anger right now with how much prices have increased right now. So you also kind of have to be a financial therapist, if you will.
Absolutely. And a lot of times I'll have the husband and wife in, and they have 2 different risk tolerances, right? So now I have to satisfy what both of them are
I would probably say that's more often than not. Don't you think that
sometimes it can be drastic, though, and so that's hard to solve sometimes, but we get through it. But yeah, so there's things that we can control. We can look at the fees that they're paying. So, a penny saved is a penny earned. We know that, right? So if we can save on the fees, that's going to help out. We want to make sure you don't have too much money in either of those buckets, right? We want to make sure we have the right blend. We always hear about, diversification, and people think about investments, but they don't think about those different money buckets. And you should really diversify that way. You should diversify by taxes. That's another way we can control things. Do some tax
diversifying in taxes. How do I diversify my own taxes? Don't I just have to pay them?
Well, what I mean by that is so many people just dump money into their retirement plan at work, right? To get
Right.
that tax
You get the
deferral, get the
401k.
matching, grow it, and maybe they're overfunding it, and that's great. I mean, saving is great, but the problem is they're tax deferring till later down the road when there's probably going to be, we're pretty
Higher
sure it's going to be higher
taxes?
taxes than they are
Okay.
today. Now, the myth is when you retire, you'll be in a lower tax bracket, right? Because you'll have less earnings. But honestly, we really just don't see that. I mean, taxes are going to go
Wait,
up.
I want you to repeat that because I read that myth all the time. People think that they're going to have a lower tax bracket in retirement because you're not earning an income. But if taxes go up and you're pulling from your savings and then eventually your Social Security and then eventually your RMDs, you could be just as high of a tax bracket?
Just as high, and taxes could be higher later than they are today. We almost know that it will be, right? So putting some of that money into a tax-free bucket like a Roth IRA, maybe converting some of your IRA now to a Roth IRA while taxes are lower, and also while the stock market is down, right? So you want to convert, when you convert your IRA, you're converting the dollar amount that's in that account right now. Well, a lot of clients, their values are down right now. Well, why not go ahead and do the conversion, and then when the market rebounds, all that growth is going to be tax-free down the road.
Right. And it sounds like a wonderful philosophy, but again, before people do a Roth conversion on their own, they also need to be aware of what they might do to their own tax bracket this year. So obviously you would say, before doing it on your own, doing all or nothing, doing a large chunk, talk with an advisor first?
Absolutely. You want to talk with someone that's licensed to do your taxes, but we can do all of the legwork, right? We can do the tax planning and then say, okay, now we're going to take this and we're going to talk with your accountant or an accountant.
So you can find out from someone like yourself, do you do it over 2 years? Do you do it over 4 years, 5 years, even 10 years? Even though the tax laws might change down the road, but you could spread it out or be doing an all or nothing. And this is part of what the On-Track Retirement Review would help with. It's not just, are you ready to retire? It's taking a look at all of this.
That is correct. Yep, it's a big part of it. So again, those are the things that we can control. You know, we can't control taxes going up, but we can control those tax buckets and make sure that we're diversified in that area.
So for the viewers out there, an on-track retirement review would include taking a look at your taxes and do you have a tax-forward strategy, taking a look at your risk, taking a look at the fees inside your investments, also legacy planning and healthcare. Am I leaving anything out? It sounds like the kitchen sink.
I think you're on track.
I think you're on track.
I think you're on track. Yeah, so we're offering that to the next 10 callers. It's completely complimentary. There's no obligation. You'll sit down with me personally, and we'll talk about your situation, and then we can go ahead and do some of that stress testing and on-track review for you.
Jerry, thank you so much. We're going to see you again next week. Thank you so much. Make sure you get your complimentary on-track retirement review at 844-878-1293. Thank you so much for watching. We will be back again with what retirement means to you next week.